I am about to share something with you that I have never discussed publicly before. The three industries where I believe we will see the most dramatic wealth creation over the next 4 years. I am not talking about modest gains. I am not talking about beating the market by a few percentage points. I am talking about industries that I believe will double in value by 2028. And I am putting serious money behind these convictions. Now, before you dismiss this as hype or speculation, let me be clear about something. I have been doing this for over 30 years. I have made billions of dollars by identifying major trends before the crowd catches on. I predicted the collapse of the bond insurers in 2007. I made one of the largest profits in hedge fund history during the COVID crash. I have a track record of seeing around corners that most investors cannot see. And right now, I am seeing something extraordinary. Three industries are converging with technological, demographic, and economic forces that will create generational wealth for investors who position themselves correctly. Most people will miss this. They will be distracted by the noise. They will chase whatever is hot today instead of positioning for what will be dominant tomorrow. But you do not have to make that mistake. Today, I am going to show you exactly where I am placing my biggest bets and why I am so confident these industries will double by 2028. Let me start by explaining my framework for identifying industries that are about to experience explosive growth. Because this is not guesswork. This is a systematic approach that I have refined over decades. There are 4 criteria I look for. First, the industry must be riding a secular trend that is irreversible, not a fad, not a cycle, an actual structural shift in how the world works. Second, the industry must have significant barriers to entry that will protect the winners from competition. If anyone can enter, profits get competed away. Third, the current valuations must not fully reflect the growth potential. The market must be underestimating how big this can get. Fourth, there must be a catalyst on the horizon that will accelerate the trend and force the market to reprice these assets higher. When I find an industry that meets all 4 criteria, I invest heavily. And right now, 3 industries are screaming at me that the time is now. The first industry I am betting will double by 2028 is healthcare technology. And I am not talking about biotech companies hoping their drug gets approved. I am talking about the companies that are fundamentally transforming how healthcare is delivered, administered, and experienced. This is one of the largest opportunities I have seen in my entire career. Let me explain why. Healthcare in America is broken. Everyone knows this. We spend more per capita on healthcare than any other developed nation, and yet our outcomes are mediocre at best. The system is inefficient, fragmented, and frustrating for patients and providers alike. Doctors spend more time on paperwork than on patients. Insurance claims get denied and appealed endlessly. Medical records are scattered across dozens of incompatible systems. Appointments are scheduled weeks or months in advance. The entire experience is stuck in the 20th century while every other industry is modernized. This creates an enormous opportunity for technology companies that can fix these problems. And the COVID pandemic accelerated adoption of healthcare technology by at least a decade. Telehealth went from a novelty to a necessity overnight. Patients discovered they could see doctors from their living rooms. Providers discovered they could treat more patients more efficiently. Insurance companies discovered they could reduce costs. And regulators discovered they needed to get out of the way. The genie is not going back in the bottle. Healthcare technology adoption is accelerating, not slowing down. But here is what most investors miss. We are still in the very early innings of this transformation. The healthcare technology market is projected to grow from around $300 billion today to over $1 trillion by the end of the decade. That is more than tripling in size. And the companies leading this transformation will capture a disproportionate share of that growth. Think about what is happening. Electronic health records are finally becoming interoperable, allowing patient data to flow seamlessly between providers. Artificial intelligence is being deployed to read medical images, predict disease progression, and recommend treatments. Remote monitoring devices are allowing patients with chronic conditions to be tracked continuously from home. Administrative tasks that consumed hours of physician time are being automated. Clinical trials are being conducted virtually, accelerating drug development. Every aspect of healthcare is being reimagined with technology at the center. The companies I am most excited about in this space share certain characteristics. They have software platforms that become more valuable as more users adopt them. They have recurring revenue models that create predictability and compounding growth. They have data assets that improve with scale, creating competitive moats. and they have management teams that understand both healthcare and technology, which is a rare combination. I am not going to name specific stocks because that is not what this is about. This is about understanding the industry dynamics that will create massive wealth over the next 4 years. If you understand the dynamics, you can identify the winners yourself. The regulatory environment is also becoming more favorable. The government is pushing for price transparency, which benefits technology platforms that can provide it. Medicare is increasingly reimbursing telehealth services, expanding the addressable market. The FDA is creating pathways for AI-based diagnostic tools, enabling new categories of products. All of these regulatory tailwinds are accelerating adoption of healthcare technology. The demographic trends are equally powerful. The baby boomer generation is aging. They are the largest generation in American history, and they are entering their years of highest healthcare utilization. This creates unprecedented demand for healthcare services, and there simply are not enough doctors and nurses to meet that demand using traditional care models. Technology is not optional. It is essential. Healthcare systems that do not adopt technology will collapse under the weight of demand. Those that do adopt it will thrive. This creates a forcing function that ensures healthcare technology adoption will accelerate regardless of economic conditions. I believe the healthcare technology sector will more than double by 2028. The secular trends are irreversible. The barriers to entry are significant because healthcare is complex and regulated. Current valuations do not fully reflect the growth potential because many investors still view healthcare technology as a niche. And the catalysts are in place with demographic shifts, regulatory changes, and technological breakthroughs all converging at the same time. Let me go deeper on specific areas within healthcare technology that I find most compelling. First, revenue cycle management. This is the process by which healthcare providers get paid for their services. It involves coding, billing, claims, submission, denials, management, and collections. It is incredibly complex and inefficient. The average hospital spends 15 to 25% of its revenue just on billing and collections. That is insane. Technology companies that can automate and streamline this process are saving healthcare providers billions of dollars, and they are growing revenue at 30 to 40% annually while doing it. The total addressable market for revenue cycle management technology is over $50 billion, and we are still in the early innings of adoption. Second, clinical decision support. Doctors are human, they make mistakes, they miss diagnoses, they prescribe treatments that are not optimal for specific patients. Artificial intelligence can help. Systems that analyze patient data and provide recommendations are improving outcomes and reducing costs. A study showed that AI could detect certain cancers in medical images more accurately than radiologists. Another showed that AI could predict patient deterioration hours before human clinicians recognize the warning signs. As these systems prove their value, adoption will accelerate. Reliability concerns that have slowed adoption are being addressed through better validation and clearer regulatory frameworks. Third, chronic disease management. Roughly 60% of American adults have at least one chronic condition. Diabetes, heart disease, obesity, depression. These conditions require ongoing management. Traditionally, that meant periodic doctor visits, where the patient would report on how things were going between visits. But technology enables continuous management. Glucose monitors that track blood sugar in real time, connected devices that monitor heart rhythm, apps that support mental health through therapy exercises and check-ins. Platforms that coordinate care across multiple providers. These technologies improve outcomes while reducing the cost of care. The economics are compelling for everyone involved. Fourth, drug discovery and development. The traditional process for developing new drugs takes 10 to 15 years and costs billions of dollars. Most candidates fail. The economics are challenging. But technology is transforming this process. Artificial intelligence can identify promising drug candidates faster and more accurately. Virtual clinical trials can accelerate testing. Real-world evidence can supplement traditional trials. Companies that are applying these technologies are dramatically reducing the time and cost of drug development. This is good for patients who get access to new treatments faster. It is good for healthcare systems that benefit from innovation, and it is good for investors in the companies leading this transformation. The second industry I am betting will double by 2028 is infrastructure. Now, I know what you are thinking. Infrastructure? That sounds boring. That sounds like slow growth and low returns. But you are thinking about infrastructure the wrong way. Let me explain what I mean. The infrastructure that powered the 20th century is crumbling. Roads are deteriorating. Bridges are structurally deficient. The electrical grid is unreliable and outdated. Water systems are failing. This is not hyperbole. The American Society of Civil Engineers gives American infrastructure a C- grade. Trillions of dollars of investment are needed just to bring existing infrastructure up to acceptable standards. But here is what makes this moment different. We are not just repairing old infrastructure. We are building entirely new categories of infrastructure for the 21st century. Electric vehicle charging networks that will enable the transition away from gasoline, data centers that will power the artificial intelligence revolution, renewable energy generation and storage facilities, semiconductor manufacturing plants being reshored to America, broadband networks reaching underserved communities. This is not your grandfather's infrastructure. This is the foundation for the next 50 years of economic growth. The investment required is staggering. The Infrastructure Investment and Jobs Act allocated over $1 trillion in federal spending. The Inflation Reduction Act added hundreds of billions more for clean energy infrastructure. The CHIPS Act is driving tens of billions into semiconductor manufacturing. Private capital is matching and exceeding these government investments. We are in the early stages of the largest infrastructure build-out since the interstate highway system was constructed in the 1950s and 60s. The companies that will benefit from this build-out are diverse construction and engineering firms that design and build physical infrastructure, materials companies that supply cement, steel, and aggregates, equipment manufacturers that make the machines used in construction, electrical equipment companies that supply transformers, switchgear, and cables, technology companies that provide software for infrastructure management. All of these sectors are positioned to benefit from the multi-year investment cycle that is just beginning. What excites me most is that the market has not fully priced in this opportunity. Infrastructure stocks are generally out of favor. They are considered boring compared to high-flying technology stocks. Valuations are reasonable relative to history and relative to growth prospects. This creates an asymmetric opportunity where the upside is substantial if the thesis plays out, but the downside is limited because valuations provide a margin of safety. The catalysts for infrastructure investment are not going away. Climate change is forcing investment in grid resilience and renewable energy. Geopolitical competition with China is driving reshoring of critical manufacturing. Aging infrastructure is requiring replacement regardless of economic conditions. Urbanization is continuing globally, creating demand for new infrastructure in growing cities. These are not temporary factors. These are structural forces that will drive infrastructure investment for decades. I want to be specific about one area of infrastructure that I find particularly compelling: data centers. The artificial intelligence revolution requires massive amounts of computing power. That computing power requires data centers, and not just any data centers. AI workloads require specialized facilities with enormous power capacity, advanced cooling systems, and high-speed connectivity. The demand for these facilities is growing faster than supply. Companies are racing to build new data centers, but construction takes years. This supply-demand imbalance will persist for the foreseeable future. The companies that own and operate data centers are printing money, their facilities are fully leased, they are raising rents, they are developing new capacity as fast as they can, and they are still unable to meet demand. The economics of data centers are beautiful. Once built, they generate recurring revenue with minimal incremental cost. Tenants sign long-term leases, providing visibility and predictability. Switching costs are high because moving data center operations is complex and risky. And the secular growth in data creation ensures that demand will continue growing for decades. I believe the data center sector specifically could more than triple by 2028, even faster than the broader infrastructure sector. Energy infrastructure is another area with exceptional potential. The transition to clean energy requires massive investment in generation, transmission, and storage. Solar and wind farms are being built at unprecedented scale. Battery storage facilities are being deployed to address intermittency. Transmission lines are being upgraded to handle the new energy mix. Hydrogen infrastructure is being developed for heavy industry. All of this requires capital investment that will benefit infrastructure companies for years to come. I believe the infrastructure sector broadly will double by 2028. The investment required is too large to be optional. The funding from government and private sources is committed. The companies involved have reasonable valuations and strong competitive positions, and the catalysts from climate, geopolitics, and technology are persistent and powerful. Let me elaborate on the specific dynamics that make infrastructure investing so attractive right now. First, there is a massive supply-demand imbalance. Demand for infrastructure investment has been building for decades as existing assets deteriorated, but actual investment has lagged because of political gridlock, budget constraints, and competing priorities. Now that dam is breaking. The accumulated demand is being released in a multi-year wave of investment. Companies that have the capacity to execute on this demand are seeing their backlogs grow to record levels. They have years of visibility into future revenue. Second, inflation actually benefits infrastructure companies. Unlike many businesses that struggle when input costs rise, infrastructure companies typically operate under contracts that allow them to pass through cost increases. When steel prices rise, the contract adjusts. When labor costs rise, the contract adjusts. This provides natural protection against inflation, and in an inflationary environment, hard assets like infrastructure become more valuable as stores of wealth. Third, infrastructure investments are increasingly being viewed as essential by both political parties. This is rare in our polarized environment. But Republicans and Democrats both recognize that crumbling infrastructure hurts economic competitiveness. They both recognize that the energy transition requires massive investment. They both recognize that competition with China requires domestic manufacturing capacity. This bipartisan support provides confidence that infrastructure investment will continue regardless of which party controls government. Fourth, private capital is flooding into infrastructure. Pension funds, sovereign wealth funds, insurance companies, and private equity firms are all increasing allocations to infrastructure. They are attracted by the stable cash flows, inflation protection, and long duration of infrastructure assets. This wall of capital seeking infrastructure investments supports valuations and provides financing for new projects. The amount of private capital targeting infrastructure has doubled in the last 5 years and is still growing. Let me talk about electric vehicle charging infrastructure specifically because I think this is one of the most compelling opportunities within the broader infrastructure theme. The transition to electric vehicles is inevitable. Every major automaker has committed to electrifying their fleet. Governments around the world are setting targets and providing incentives. Consumer adoption is accelerating as range improves and prices decline. But the charging infrastructure needed to support widespread EV adoption does not yet exist. America has about 150,000 public charging ports today. We need millions. This gap must be filled, and the companies that fill it will create enormous value. The economics of EV charging are attractive. Once a charging station is installed, it generates revenue for decades with minimal ongoing cost. The capital intensity is front-loaded. Utilization increases over time as EV adoption grows, and there are opportunities for additional revenue from advertising, convenience store sales, and grid services. The companies building out charging networks today are establishing positions that will be very difficult to replicate once the market matures. Grid modernization is another critical area. The electrical grid was designed for a world where power flowed one direction, from large centralized power plants to consumers. The new energy system is different. Solar panels on rooftops generate power. Batteries in homes and cars store power. Electric vehicles draw power at varying times. Wind and solar generation fluctuate with weather. Managing this complexity requires a smarter, more flexible grid. The investment needed to modernize the grid is measured in hundreds of billions of dollars. The companies that provide the equipment, software, and services for grid modernization are positioned for decades of growth. The third industry I am betting will double by 2028 is financial technology. And I mean this in the broadest sense. Companies that are using technology to transform how financial services are delivered. Payments, lending, insurance, wealth management, banking. All of it is being disrupted by technology companies that are faster, cheaper, and more customer-friendly than traditional financial institutions. Let me tell you why I am so excited about this space. Financial services is one of the largest industries in the world. Banks, insurance companies, and asset managers collectively generate trillions of dollars in revenue annually. But most of this industry is still running on technology that is decades old. Core banking systems were built in the 1970s. Insurance underwriting still relies heavily on manual processes. Payment systems have multiple intermediaries, taking fees at every step. The inefficiency is extraordinary. And where there is inefficiency, there is opportunity for technology to create value. The pandemic accelerated digital adoption in financial services, just as it did in healthcare. Consumers who had never used mobile banking started using it. Businesses that relied on paper checks shifted to digital payments. Investors who used traditional brokers discovered commission-free trading apps. Insurance companies that required in-person assessments adopted remote processes. All of these behavioral changes are sticky. People do not go back to less convenient options once they have experienced better alternatives. The areas of financial technology that excite me most are those where the technology company becomes embedded in the customer relationship. Payments are a perfect example. When a consumer uses a particular payment app or card, they develop habits around it. Their transaction history is stored there. Their rewards accumulate there. Switching becomes increasingly costly over time. This creates powerful network effects and switching costs that protect the leading companies from competition. Lending is another area being transformed. Traditional banks make lending decisions using limited data and slow processes. Fintech lenders use alternative data sources, machine learning models, and automated workflows to make faster and more accurate decisions. They can approve loans in minutes that would take banks weeks. They can serve customers that banks would reject because they can better assess creditworthiness. And they can do all of this at lower cost because they do not have legacy infrastructure to maintain. Embedded finance is perhaps the most exciting trend in financial technology. This is when financial services are integrated directly into non-financial platforms. When you buy something on an e-commerce site and are offered financing at checkout, that is embedded finance. When a software platform offers its customers working capital, that is embedded finance. When a gig economy platform provides instant access to earnings, that is embedded finance. These embedded offerings are growing explosively because they meet customers where they already are, rather than requiring them to go to a bank. The wealth management industry is also being transformed. Traditional advisors charge 1% of assets annually for services that can increasingly be automated. Robo-advisors provide portfolio management at a fraction of the cost. Direct indexing allows customization that was previously available only to the ultra-wealthy. Commission-free trading has democratized access to markets. All of these changes are expanding the addressable market by making wealth management accessible to people who were previously unserved. Insurance technology is another fertile area. Insurance is fundamentally about pricing risk. Companies that can price risk more accurately can offer better rates to good risks and avoid bad risks. Technology enables more accurate pricing through better data collection, more sophisticated modeling, and faster claims processing. The companies that are leveraging these advantages are taking share from traditional insurers who are stuck with legacy systems and legacy thinking. The regulatory environment for financial technology is evolving but generally becoming more favorable. Regulators recognize that innovation benefits consumers through lower costs and better service. They are creating sandboxes for experimentation. They are modernizing rules to accommodate new business models. Yes, there are also increasing scrutiny and consumer protection requirements. But on balance, the regulatory trends support continued growth in financial technology. I believe the financial technology sector will double by 2028. The size of the opportunity is enormous given the scale of financial services globally. The technology advantages are real and sustainable. Current valuations are reasonable following the correction in growth stocks over the past few years. And the catalysts from continued digital adoption, embedded finance growth, and regulatory evolution are in place. Let me go deeper on why the timing is particularly attractive for financial technology right now. The sector experienced a massive bubble in 2020 and 2021. Valuations reached absurd levels as investors extrapolated pandemic-era growth rates forever. When interest rates rose and growth slowed, these stocks crashed. Many are down 60, 70, even 80% from their peaks. But here is what most people miss. The businesses did not crash. Revenue kept growing. Market share kept expanding. Product development kept progressing. What crashed was the multiple that investors were willing to pay. And now those multiples have normalized. You can buy high-quality fintech companies at reasonable valuations for the first time in years. This is when the best investments are made. Not when everyone is excited and prices are high, but when everyone is skeptical and prices are low. Let me talk about the payments ecosystem in more detail because I think this is where some of the biggest opportunities exist. Every time money moves, multiple companies take a fee. The merchant acquirer, the card network, the issuing bank, the payment processor. These fees add up to hundreds of billions of dollars annually. Technology companies that can reduce friction in payments, that can eliminate intermediaries, that can provide better service at lower cost, will capture share of this massive pool. And unlike many technology businesses, payments companies have proven business models. They are profitable, they generate cash, they are not burning money, hoping to achieve scale someday. Cross-border payments is a particularly attractive niche. Moving money across borders using traditional banking rails is slow, expensive, and opaque. A wire transfer can take days. Fees can be 5% or more. Exchange rates are unfavorable. Technology companies are solving these problems. They are using new rails to move money faster and cheaper. They are providing transparency into fees and exchange rates. They are serving customers like small businesses and immigrants who have been overcharged by traditional players for decades. The market for cross-border payments is over $150 trillion annually. Even capturing a small share represents enormous revenue. Buy now, pay later is another area that has matured after its initial hype cycle. The concept is simple. Instead of paying the full price at checkout, consumers can split their purchase into installments. For consumers, this provides flexibility. For merchants, this increases conversion and average order value. For lenders, this provides access to transaction data that enables better underwriting. The business model works. Default rates are manageable, unit economics are attractive, and the product is being integrated into more and more checkout experiences. After the shakeout of the past 2 years, the surviving companies are stronger and better positioned. Banking as a service is enabling a new generation of financial products. Traditional banks have licenses, regulatory expertise, and core banking infrastructure that are difficult to replicate. But they are often slow to innovate. Banking as a service companies provide the infrastructure that allows non-banks to offer financial products. A software company can offer its customers bank accounts. A retailer can offer credit cards. A gig platform can offer instant payouts, all powered by banking as a service providers that handle the regulatory complexity behind the scenes. This model is growing rapidly and creating value for all participants. Blockchain technology is finally finding practical applications in financial services. I am not talking about speculative cryptocurrencies. I am talking about using blockchain infrastructure to improve settlement, reduce counterparty risk, and enable new types of assets. Tokenization of real-world assets like real estate, art, and private equity is creating liquidity in previously illiquid markets. Stablecoins are providing efficient rails for moving value. Smart contracts are automating complex financial transactions. The speculation has faded, but the useful applications are growing. Let me also address wealth technology, because this segment has particular potential. The amount of wealth in the world is growing. Baby boomers are transferring trillions to the next generation. Young people are entering the workforce and beginning to save. Emerging markets are creating new wealth. All of this wealth needs to be managed. Traditional wealth management is expensive and exclusionary. Technology is democratizing access and reducing costs. Automated investing, fractional shares, social trading, personalized portfolios, all of these innovations are expanding the market for wealth management services. The companies leading this transformation are growing revenue rapidly while achieving profitability. Now let me explain how these three industries connect and reinforce each other. Because this is not just about picking three random sectors. There is a unifying thesis. Technology is transforming every industry. But some industries have been slower to adopt technology than others. Healthcare, infrastructure, and financial services are all industries where technology adoption has lagged. They are complex. They are regulated. They have entrenched incumbents. But those barriers are breaking down. And when technology transforms an industry that has been slow to adopt it, the value creation is explosive. Think about what happened to retail when e-commerce arrived. Amazon did not just take a little share from traditional retailers. It destroyed entire categories. Department stores, bookstores, electronics retailers, all devastated by a technology-driven competitor. The same pattern is playing out now in healthcare, infrastructure, and financial services. Technology-driven companies are not just nibbling at the edges. They are fundamentally transforming how these industries operate. Let me share my approach to investing in these industries. I do not try to pick the one winner in each space. That is too difficult and too risky. Instead, I invest across multiple companies that are positioned to benefit from the broader trend. Some will be bigger winners than others. Some might disappoint. But if the industry thesis is correct, the portfolio will perform well overall. This diversified approach within a concentrated thesis gives me the best risk-adjusted returns. I also pay close attention to valuation. Even the best industry can be a bad investment if you pay too much. I look for companies where the current stock price does not fully reflect the growth potential, where the market is skeptical or inattentive, where I can buy growth at a reasonable price. This discipline has served me well throughout my career. I have avoided many disasters by refusing to pay excessive valuations, even for companies I loved. Timing is another important consideration. These industries will not double in a straight line. There will be volatility. There will be setbacks. There will be periods when these stocks underperform, and I look foolish for owning them. That is fine. I am not trying to predict short-term price movements. I am trying to position for long-term value creation. If my thesis is correct, the destination is what matters, not the path. I want to address the risks because no investment is without risk. For healthcare technology, the main risks are regulatory changes that could slow adoption, reimbursement pressures that could squeeze margins, and competition from big tech companies entering the space. For infrastructure, the main risks are political changes that could reduce government investment, rising interest rates that could increase project costs, and supply chain disruptions that could delay construction. For financial technology, the main risks are regulatory crackdowns that could limit growth, credit losses that could impair lending businesses, and competition from traditional financial institutions that are finally modernizing. I have considered all of these risks. I believe the opportunities outweigh the risks in each case, but I am not blind to the possibility that things could go wrong. That is why diversification within each industry is important. That is why maintaining valuation discipline is important. That is why having a long-term time horizon is important. These practices do not eliminate risk, but they make risk manageable. Let me close with some perspective on why I am sharing this publicly. I believe in the democratization of information. For too long, the best investment ideas have been available only to the wealthy and connected. Hedge fund managers like myself would share ideas with their investors and keep everyone else in the dark. But I think that is changing, and I think it should change. If I see opportunities that can help ordinary investors build wealth, I want to share that. Yes, I benefit too because I already own these investments, but that does not make the ideas less valid. Judge the logic, not the messenger. The next 4 years will create enormous wealth for investors who are positioned correctly. Healthcare technology, infrastructure, and financial technology are the three industries where I see the most compelling opportunities. I am putting serious capital behind these convictions. I encourage you to do your own research, draw your own conclusions, and invest according to your own circumstances. But I am confident that those who invest in these industries today will look back in 2028 and be very glad they did. The trends are clear, the timing is right, the opportunity is exceptional. Do not miss it.